Hello friends, welcome to today's session. Today we will learn how to pass journal entry. I have taught you in the previous videos the rules of debit and credit, both the traditional and the modern approach. Now we are going to be applying those rules of debit and credit and learn passing of journal entry. So first let me introduce you to the concept of journal. What do we mean by journal entry? Now, journal is called as book of original entry. Now, when in a business transactions takes place, they are recorded in the books for the first time in journal. So that is why journal is called as book of original entry. That is a place where it gets recorded first. They are also known by other name like book of prime entry. It is also called as principal book. It is a book where it gets recorded first. Now, while transaction take place, the transaction results in creation of some source documents. The source documents that we're talking about here are the bills or the invoices or the cash memos that are getting created here. These are the source documents from which we get the information about the transaction and are able to record the transaction. Using the source documents, accounting vouchers are prepared. Accounting vouchers are vouchers prepared by the accountant, where you will get the detail on the basis of source document. Whatever has been extracted is put into the accounting voucher, and the accounts which are debited or credited will be known from the accounting voucher. This becomes a source document for the bookkeeper who is passing the journal entry, that is when he is passing the journal. Now, for passing the journal entry, we need to know the rules of debit and credit. Now, in the previous videos, I have discussed in detail the rules of debit and credit as per the traditional approach as well as the modern approach. You can use any one of this approach, whichever is easier for you. Both are on the same level. It will give the same result, but there are two different approaches available which you can choose which you want to use on the basis of your own ease. Now, just to revise the rules of debit and credit before we start passing the journal entry, as per the traditional approach, we divide the accounts into three types. One, personal accounts. The second is the real account. And the third one was the nominal account. Now we had learned the rules of debit and credit for personal account is debit the receiver and credit the giver. For real account, the rule is debit what comes in and credit what goes out. And for the nominal account, the rule was debit all expenses and losses and credit all incomes and gains. So I think now you have recollected the rules of debit and credit as per the traditional approach. Now going into the modern approach. The accounts were classified into 5 categories. 5 categories were asset account, where increases are debited and decreases are credited to asset account. Second classification was liabilities, where the increases in liabilities are credited and Decreases in liabilities are debited. Then we had the capital account. The increases are credited, and when there's a decrease in capital, it is debited. Next, we have the revenue accounts. That includes all our incomes and gains. The increases are credited and decreases are debited. Finally, last classification we had was the expenses account. When increases are debited, decreases are credited. Now with this quick revision, we now know the rules of debit and credit, which we will be using today to pass the journal. Before going into the passing journal entry, let us summarize what is journal. It is a book of original prime entry, also called as principal book. And this process we follow of recording the transaction in the journal of the business is called as journalizing. And whatever entry that we pass in the journal, it is called as journal entry. So the entry passed in the journal by applying the rules of debit and credit is called as journal entry. Now let us understand the format of a journal. How do we record it in the journal? The transactions are recorded in the journal in this format. First, you have the date column where you write the date of the transaction. So if on April 3rd there was a purchase, then you write 2021 April 3rd. That is the date of the transaction. Next, in particulars, here we pass the entry. We debit and credit the accounts. Which account is debited, which account is credited. And then it is followed by what is called as narration in brackets, where we write the brief description of the transaction. Like if it was purchase of goods, then we write being the purchase of goods for cash. That is a description called as narration. The third column is ledger folio. Ledger folio. The transaction that is recorded in the journal is going to get posted into the ledger book into the respective accounts. Like from the transaction of purchase, the purchase transaction is going to go into the purchase account which is opened in the ledger. So the page number in which the ledger page number is going to be recorded here. Suppose the purchase account has been opened in page number 12. Then that page number would be written against the purchase account here. And the amount which is debited would be written in the debit column, and the account which is credited, that amount would be written in the credit. So this is the format in which we would be passing the journal entry. So now I think you are ready to pass the journals. So before that, let us summarize the steps which we are going to follow systematically. If you follow these steps, passing of journal entry would be very easy. So what are the steps in journalizing? First step is to identify the accounts involved in the transaction. So when a transaction is given, you identify the transaction accounts which are involved in the transaction. After having identified those transactions, analyze and see what is the nature of the accounts. That is, if it is a cash account, then it's a real account or an asset account as per the modern. If it is a purchase account, then it's a nominal account as per traditional approach. Modern approach, it is an expense account. So like that, we would identify the nature of accounts. Either you follow traditional or the modern approach. And then we identify the accounts to be debited or credited as per the rules of debit and credit. Having identified the accounts, we will see whether there is an increase or decrease, or on the basis of the accounts, we'll apply the rules of debit and credit and see which account is to be debited, which account is to be credited. Once that has been identified, we will determine the amount which is to be debited and credited. Then we would record that particular transaction as a journal entry in the journal. So 5 simple steps to be followed to pass journal. So shall we start now? First transaction. Dharam started business with cash rupees 2 lakh. So first step is to identify the accounts involved. Here there is cash, and as he started business, he has brought in cash for capital. First step done. Second step, identify the nature. Here, as per the traditional approach, this cash account and capital account. Capital account is a personal account and cash account is a real account. Now, as per the modern approach, if you see, the cash account is an asset account and capital account is a capital. So first, as per traditional approach, I'll tell you, real account, cash. The rule is debit what comes in, credit what goes out. In this transaction, cash is being brought in, so we would debit the cash account. And capital account being personal account, debit the receiver, credit the giver. So capital is being given here, so we credit the capital. This is as per the traditional approach. If you are comfortable with the modern approach, then cash account is an asset account. Increases are debited, decreases are credited. Here cash is coming in, so cash is increasing. So we debit it. Capital, it's a capital account. Increases are credited, decreases are debited. Now here capital is brought in, so capital balance is increasing. So capital increases are credited. So we have identified the rules of debit and credit and also identified whether we have to debit or credit. Now final step is passing of the entry. Now here the date is not specified. Suppose I gave the date as 1st April 2021. Then you write 2021 April 1st in the date column. Then you write the transaction. First the debit. So cash account debit. We write the amount 2 lakh. 2. Capital account 2 lakh. And then don't forget we have to write a narration being cash introduced as capital. This is a brief description of the transaction called as narration. Now let us do the next one. Purchase goods 50,000 for cash. So first step, identify the accounts involved. Purchase account, and because it is for cash, the other account is the cash account. Now both the traditional and the modern approach classification will do. As per traditional approach, purchase account is a nominal account and cash account is a real account. Rule for nominal account, debit all expenses and losses, credit all income and gain. So purchase expenses, so we debit. Cash, real account. The rule, debit what comes in, credit what goes out. Here when this purchase of goods for cash, cash is going out. So we have to credit cash. Now as per modern approach, if we find out, purchase account is a expense account and cash account is an asset account. Now for expenses, increase in expenses debited, decrease in expense credit. Here there is a purchase, so there is an increase in expense, so we debit it. And cash here is an asset account. Increase in asset would be debited, decrease in asset would be credited. Your cash is going out, so cash is getting reduced, so it has to be credited. So now having identified, the next step would be write the date as is given in the transaction. If not given, leave it blank. Then write the entry. We have to debit purchase. So write purchase account debit to cash account 50,000. Then the brief narration being goods purchased for cash. Hope this is clear. Let us move on to one more. Sold goods to Madan for 30,000. Again, first step, identify the accounts. goods have been sold to Madan, first you will have to identify whether it's a cash or a credit sale. Here, cash term has not been used. The name of the person, the customer name has been given, which means it's a credit sale. So the two accounts involved would be Madan and sales. Now, as per traditional approach, Madan is a personal account and sales is a nominal account. The rule for personal account is debit the receiver, credit the giver. Your goods are being received by Madan because we have sold the goods to Madan. So he has to be debited. Sales being a nominal account, the rule is debit all expenses and losses, credit all income and gain. Sales is an income for the business. So we have to credit. If we go by the modern approach, Madan is a asset account and sales is a revenue account. So for asset, increases are debited and Madan is a debtor, he's coming in, our asset is increasing in the form of debtor, so we have to debit. For revenue account, increases are credited, decreases are debited. Your sales is increasing, so we credit it. So now the journal entry would be the date given, then you write Madan account debit. 2. Sales account. Transaction value is 30,000 debited to Madan and sales credited by 30,000. Write the narration being goods sold to Madan on credit. I hope it is clear. Let us do one more. Purchase computer rupees 40,000 from Computer Mart. Here the accounts, identify the accounts. The accounts involved are computer which is being purchased, it's an asset, and there is no payment in cash or through checks. So this is a credit purchase, payment not yet made. So the account would be computer. Now, as per traditional approach, computer is a real account and Computer Mart would be a personal account. So what is the rule of real account? Debit what comes in, credit what goes out. Here we have purchased computer, so computer is coming in. So we debit it. For personal account, debit the receiver, credit the giver. Here computer is received by the business and the giver is the Computer Mart. So credit the giver, so we credit it. Now looking at the modern approach, computer is an asset account and Computer Mart is a liability account. So the rule for asset account is when it increases, we debit it. Your computer has come in, so computer balance is increasing. So we debit it. Computer Mart is a liability because the amount is still payable by the business to Computer Mart. So liability is increasing. The rule of debit and credit for liability account is when it increases, we credit it, and when it decreases, we debit it. Here the liability is increasing, so we credit it. Passing that entry here, right? Computer account debit to Computer Mart account. The value of the computer debited to computer 40,000, credited to Computer Mart being computers purchased from Computer Mart. I hope it is clear. Now, one more. Paid salary to staff rupees 15,000. Here salary is being paid to the staff. So identify the accounts. Accounts involved are salary and cash. Now, what type of account is salary account as per the traditional approach? It is a nominal account and cash account is a real account. rule of debit and credit for nominal account is debit all expenses and losses, credit all income. Salary is an expense of the business. It has to be paid to the staff. So we have to debit. Cash is a real account and the real account rule is debit what comes in, credit what goes out. Here cash is being paid, so cash is going out of the business. So we have to credit cash. Now let us look at the modern approach. As per that, modern approach salary comes under the expense account category and cash comes under the asset category. Now, what is the rule of debit and credit of the expense account? When it increases, we debit, decreases are credited. Here expense is increasing, so we have to debit. And here cash is an asset. Asset increases are debited, decreases are credited. Cash is decreasing as it is being paid, it's going out. We have to credit. So now let us pass the entry. Write the relevant date where given in the question. Then pass the entry. Salary account debit 15,000. The debit column to cash account in the credit column 15,000 being salary paid to staff. So this is how, by using the rules of debit and credit and by following the simple 5 steps, we can very easily pass the journal entry. I hope with this that the passing journal entry is very clear to you. If you found this video useful, please do like, share and subscribe to it. And to get continued notification, please hit on the bell button. And if you have any doubts or query, please leave your queries in the comment section below. Thank you. Have a great day.